Hello and welcome back. In this video, I will take a look at a split corp fund which I have been tracking ever since it started trading back in 2018. This is the E split corp fund. The E here represents Enbridge, which is the only holding within this fund. In this video, I will go over how split corp funds work in general and why I think this particular split corp fund is better than others on the market. As with every investment, there are pros and cons associated with this investment, so I will go over them as well. Now, let us first understand what is a split corp fund. As the name suggests, a split corp fund is a type of fund where the holdings are split into two different types of shares, the Class A shares and the preferred shares. Ideally, the split takes place in a 50-50 ratio, so there will be equal number of Class A and preferred shares, although there might be exceptions to this. By doing this split, the fund is able to offer two different types of investment with different features. First, let us take a look at the features of preferred shares. These shares are aimed at people who are looking for a safe, low risk income generating investment. Preferred shares on average offer a 5 to 6% annual yield, and the price of these shares, for the most part, does not fluctuate. There might be some minor fluctuations during highly volatile markets, but in general, the price remains the same. So we can think of this as a low risk alternative to savings account that definitely pays a higher income than a typical savings account. The Class A shares, on the other hand, are the exact opposite of preferred shares. These shares are designed to capture all the capital gains or losses of the underlying holding. But since they account for approximately 50% of the shares issued by the fund, this creates a leverage effect when it comes to the stock price movement. At the same time, this leveraged effect also helps these shares pay out a very high income yield, which could range from anywhere between 12 to 18%, depending on the price of the shares at the time of buying them. This makes the Class A shares quite special because they are able to provide leverage without using any actual leverage. The leverage comes from the way the fund is structured rather than borrowing funds from outside. Here are a few examples of split corp funds highlighting the share prices and income yields for both Class A and preferred shares. There are a few other things to keep in mind when it comes to this type of investment. First, being the fact that income for Class A shares is paid out on a monthly basis, whereas for preferred shares, it is paid out on a quarterly basis. Another thing to keep in mind is that split corp funds are classified as closed end fund. This classification simply refers to the way shares of that fund are traded on the exchange. Closed end funds offer a one time offering of shares, and after that, they may trade at a discount or premium in comparison to their net asset value. Open end funds, on the other hand, constantly issue and redeem shares at the net asset value, making sure that the price of the share reflects the actual net asset value. Exchange traded funds like HYLD and USCL are examples of open end funds. The phenomenon of trading at a discount or a premium is something quite unique to closed end funds. Depending on how someone views this, it may be seen as a positive or a negative factor. In the next section, where I review the e-split corp fund, I will go into further detail on how much this impacts us as an investor. Last but not the least, when it comes to split corp funds, it is possible that they miss out on their income payouts. This happens when the unit NAV of the fund goes below $15. The unit NAV represents the total of the Class A shares and the preferred shares. Ideally, when the fund starts trading on the market, the unit NAV is $25, with $10 represented by the preferred shares and $15 represented by the Class A shares. As mentioned before, the value of preferred shares experiences very little change, and all the underlying holdings price movement is captured by the Class A shares. Over time, if the underlying holdings of the fund are not doing well, then the value of Class A shares would also go down at an accelerated pace. Under such circumstances, to preserve the long term health of the fund, they stop paying out dividends or income payouts if the unit NAV goes below $15. This, however, only happens with the Class A shares. The preferred shares continue to receive the income payouts on a quarterly basis. Since the preferred shares do not experience any major change in their value, it is usually the Class A shares that tend to lose their value below $5, causing the unit NAV to go below $15 and resulting in no income being paid out during the months where the value remains below this threshold. Once the underlying holdings recover and the value of the Class A shares goes above $5, and subsequently the overall net asset value goes above $15, the income payouts are reinstated. For some investors, this could be a big detriment, as you do not wish to miss out on your income, especially in a bearish market. In fact, for me, this was a major factor of consideration and the main reason why so far I have not invested in any split co funds. But the performance of eSplit Corp fund over the past few years has been quite encouraging, and we will see in the next section how it counterbalances some of these negative aspects associated with split Corp funds in general. So without further ado, let's review the eSplit Corp fund. The eSplit Corp fund is managed by the Middlefield Group, which is quite a well established fund management company in Canada, and they have a number of ETFs and mutual funds in addition to split Corp funds. Everything I've mentioned about split Corp funds so far is applicable to eSplit Corp fund as well. This fund offers both Class A and preferred shares. The ticker symbol for the Class A shares is ENS.TO or simply ENS, and the ticker symbol for the preferred share is ENS.PR.A. The Class A shares have a yield of around 11%, while the preferred shares have a yield of around 6%. Looking at the current share price of Class A shares at $14.46, it is trading at a discount of over 13% when compared to its net asset value at $16.39. This is the first reason why I'm considering buying this fund now. In my explanation earlier, I did mention that buying at a discount or a premium is not a big deal since it is possible that these valuations can change afterwards. All the same, it is still safer to buy Class A shares at a discount because that means you have that much more wiggle room during a bearish market to ensure that the dividends are paid out even if the stock value goes down. Especially if the discount is over 10%, then it is definitely a great deal. Remember, the dividends are paid out based on the net asset value and not the share price. So, if the net asset value is higher than the share price, then it is definitely a great time to buy. The second and the most important reason why I think this fund is a great investment is because of its holding, Enbridge. This is a major company not just in Canada but across North America, and I like to think of it as an essential company, one which has a robust, well established business and operates in an industry where there is constant demand for its product. Enbridge is primarily known for its liquid and natural gas pipelines, and in addition, it also has investments in renewable energy projects. This company has a stellar history of paying out dividends consistently and also increasing them over time. This means that there is less pressure on the fund to generate income through covered call writing, since part of the income is coming from the dividend paid out by Enbridge themselves. Also, the Enbridge stock has a low beta of 0.87. The beta is a measure of how volatile a stock is compared to the broader market. A stock with a beta of 1 is considered to be as volatile as the market. A stock with a beta of more than 1 is considered to be more volatile than the broader market. With Enbridge, since the beta is less than 1, it is less volatile than the broader market. This is very important, especially in case of Class A shares, which experience a leveraged effect due to the way the fund is structured. This leveraged effect is equivalent to approximately a 2x leverage fund. So if Enbridge stock goes up by 1%, the Class A shares would go up by 2%. On the other hand, if Enbridge stock went down by 1%, the Class A shares would go down by 2%. This would have been quite problematic if Enbridge was a highly volatile stock, since we know that leveraged ETFs often end up underperforming the underlying stock over the long term. We can see this with a simple example. Let's say a stock valued at $100 goes down by 10% and its leveraged version goes down by 20%. So the new values are $90 for the main stock and $80 for the leveraged version. The following day, the stock goes back up by 10%, bringing its value to $99. The leveraged version also goes back up by 20%, but from $80, it only manages to come back to $96. In this case, the leveraged version underperforms the main stock because of high fluctuations in the price. This is less likely to happen with the Class A shares of the E-Splitcoff fund because Enbridge itself does not go through any massive fluctuations in stock price. So, despite being leveraged, the Class A shares are less likely to experience value erosion in the long term. Combine this with the fact that the E-Splitcoff fund's Class A shares are paying out a higher income yield compared to the Enbridge stock because of the same leveraged effect. And we have an investment which is maximizing the benefits of its underlying holding without taking too much additional risk. If you look at the return of the E-Splitcoff fund and compare it with Enbridge, we find that in the past 1 year, E-Splitcoff fund has outperformed Enbridge. This is most likely due to the writing of covered calls done within the E-Splitcoff fund, combined with the recent uncertainty in the stock market caused by the tariff wars, resulting in higher income on those options. If we zoom out further and take a look at their all-time returns, then Enbridge ends up being the better performer. Once again, highlighting that covered call based investments tend to outperform during uncertain market conditions, but the underlying holdings end up being the better performer in the long term. Last but not the least, I wish to highlight that the Class A shares of this ETF are quite resistant to bearish market conditions as well. Earlier in the video, I highlighted how the Class A shares stop paying dividends if the net asset value of the fund goes below $15, which is generally caused by the NAV of the Class A shares going below $5, since the NAV of the preferred shares almost always remains at around $10. If we look at the history of this fund's Class A shares, we find that even during the most bearish market, which was the 2020 market crash, the Class A shares only went as low as $9.95. After that, as soon as the market recovered, the Class A shares recovered immediately to their usual trading price, reaching a peak at $16. When looking at similar split curve funds, you will notice that most of them go down during a major bearish market, but after that, they have a hard time recovering to their pre market crash trading price. This is not the case with E-Splitcoff fund. This again we can attribute to the fact that the Enbridge stock itself is a low volatility stock. Hence, even during major market crashes, it does not end up having any massive fluctuations. Consequently, the Class A shares of E-Splitcoff fund are able to maintain their value well above the $5 threshold required to pay out monthly income, and at the same time recover to their pre-market crash valuations as soon as the market becomes bullish. In conclusion, the E-Splitcoff fund is an excellent investment to boost the overall income percentage of your portfolio. In terms of total return, the Class A shares will more or less perform similar to the Enbridge stock itself. Like most covered call based investments, the Class A shares of this fund will outperform Enbridge in a bearish or sideways market, but will underperform in a bullish market. I haven't really spoken much about the preferred shares because there is not much to talk about them. They provide a 6% yield, but there is no scope for growth of your investment. And as such, you are better off buying directly into the Enbridge stock, which also provides approximately 6% yield, but there is scope for growth of their shares. What makes the e-Splitcoff fund stand out compared to other similar investments is its underlying holding, Enbridge, which provides a unique combination of high dividend yield and very low volatility. And this perfectly complements the structure of the Class A shares, where we get the maximization of the income while at the same time mitigating the risk of leverage. Now, there is the risk of the fund being too concentrated in just one company. But Enbridge is an integral company for energy provision, not just in Canada, but across North America. In fact, I like to think of it as one of the too big to fail companies. I already hold shares of Enbridge, so buying the Class A shares of the e-Splitcoff fund is just another way of being invested in this company. And with that, we have come to the end of this video. As always, the information and opinions provided in this video are based on my research and understanding and do not constitute investment advice. Please do your own due diligence before making any investment decisions. Thanks for watching. If you found some value in this video, don't forget to like, share, and subscribe. I will see you guys in the next one.